I'm Kevin Steinberg, Chief Operating Officer of the World Economic Forum USA, and it's a real pleasure for me to be here this morning. I'm here as I oversee our new Risk Response Network, a major effort of the World Economic Forum to focus on a set of projects and initiatives to help global leaders better understand, respond to, and prevent and prepare for some of the most complex global risks. This particular session is closely tied to the Risk Response Network, highlighting an important issue with respect to how corporates, governments, and other players around the world can respond to the next shock. I encourage all of you throughout the meeting the next several days to approach me or any of my colleagues to talk about how you can engage and involve yourselves in this very important initiative. But without further ado, I turn over the mic to Fareed Zakaria from CNN and our able and talented panel, and look forward to hear very much all of your perspectives. Thank you for joining us.
Thank you so much, Kevin. Great pleasure to be here. We really have an extraordinary panel, leaders in their fields, all of them. You have the bio data, so I'm not going to waste your time or theirs with introductions. I thought we'd get right into the central questions we're trying to discuss. And the basic question I think everyone is wondering about is the system safer today? Are there going to be future shocks? The simple answer to that is obviously yes, but of what kind, and can we prepare for them? So I'm going to start with Jamie Dimon, who has been widely credited with having steered JPMorgan Chase through the crisis, perhaps better than any banker in the United States, certainly. Jamie, when you look out at the world, do you worry about the easy money and the low cost of capital and what it can do? The reason I ask this is, of course, many people believe we got into the problems we did in the financial crisis because there was too much easy money. The cost of capital had collapsed. It was too easy to get loans, too easy to get leverage. People were borrowing too much. Banks were giving too much credit. Now, the solution to this problem has been easy money. Allowing people to take lots of debt, encouraging people to take mortgages. In other words, the solution is the very set of factors which were supposed to have caused the problem. Is this a danger?
So I do think it's a danger, but to put it in a little historical context, that we've had, I think when you plan for risk at all, you got to assume there are going to be issues you don't always understand. And you don't always know what the path is going to take. In fact, the problem that low interest rates caused last time may not be the problem it causes this time. And so I think wise people prepare for tough times. Does not mean that mankind should accept them. My guess is 500 years from now, we're going to be looking back to how we manage economies a little bit like we look at medicine today, like how they used to bleed people and they had certain problems. We're not particularly good at it. And I think we're still learning enormous lessons. And I think the actual risk from some of it is lower. Corporations from low rates and leverage is way down. Hedge funds are less leveraged. Private equity is less leveraged. Banks are less leveraged. Corporations have a lot of money. So I think the leverage issue has been reduced, and it's kind of, if you look at it, it's gone to the governments who now have too much kind of leverage, which you see in the sovereign crisis. So I do think it did cause part of the problems from last time, but only because there was a mountain of other problems waiting to be exposed. You know, from bad mortgage underwriting to certain bad accounting to gaps in the regulatory system. Some of those things are not there today. So I think it's very different if it happens.
But do you worry about what's going to happen the day the Fed starts raising interest rates, the day some of these these mortgages, the federal government stops guaranteeing them? You know, once it starts withdrawing the kind of life support it's given to the economy, what happens?
Right. So I don't think the Fed is going to stop withdraw it all of a sudden. I think they'll be looking at the same things you're looking at. Is employment going up several 100,000 a month? Is the economy strong? There's very little wage pressure. There's still overcapacity. So I don't think they're just going to pull it out. I think they're going to try to do it kind of wisely. You know, there's still a lot of monetary and fiscal stimulation around the world. There's still an enormous amount of cash in the balance sheet of companies. A lot of individuals' pension plans have too much cash. That will eventually be put to work. So I think there's also a risk where by the time they pull it, there'll be too much inflation. Now, if we have interest rates go up 200 basis points, a little inflation, and real growth and job creation, we're all going to be very happy. So, and that's obviously the goal. the risk is you have the inflation without the growth, or just no growth and no inflation. And so I'm a little optimistic. I think it's a stronger system out there today than it was 3 years ago.
Dominic, when you look at this recovery, and it's 3-speed or 5-speed, the one thing is pretty clear, is that the emerging world is providing a lot more of the stimulus, a lot more of the juice of this recovery. Is that sustainable?
I think it is. I mean, I'm optimistic, but that said, I think we have to also be aware of bubbles. I mean, I think the main driver that I look at when you look at the emerging market growth, especially in China, India, Indonesia, and even Brazil, is urbanization. There's a massive urbanization like we've never seen in our human history that's going on, and that's very difficult to stop. The Chinese have actually tried to reduce it or stop it. You can't, and that's driving a lot of the changes that are going on. But that said, when you have sort of, unremitted growth at that level, you are going to see bubbles. I cannot think of a single country that's got to $10,000 GDP per capita without some sort of a financial crisis. It's our history. So I'm optimistic, but I think we have to be very wary of bubbles that emerge as you go through. But as Jamie says, I think that the challenge is it's hard to pick where it is.
Klaus, is one of the bubbles that we need to worry about commodity prices, and how should we think about it? Because what I'm struck by is as commodity prices rise, as copper rises, as oil rises, energy prices rise, particularly with commodities, everybody says, well, we shouldn't worry about it because ultimately it doesn't make up core inflation. Is this going to look the way it did, in retrospect, in 10 years ago, people were saying, well, the Fed doesn't need to worry about asset bubbles. They don't need to worry about housing prices. They don't need to worry about these things because that doesn't cause problems. The rising commodity price is a serious problem, and could they potentially be the next shock to the system?
I think yes, but maybe I start a little before that, add to Dominic's point, because in reality, the reason why I believe the world has become more volatile is because of urbanization, but urbanization is actually accelerated by population growth. We're going through a phase of dramatic population growth, 3 billion more people on this planet. That has never happened before, and it gets accelerated by urbanization, right? So you always have to see that in the background as a driver, and then comes all other things, and natural resources as well is one of the aspects there. Second thing I would say, the late Charles Kindleberger has taught us a lesson, I think, in a very, very good way. There will be shocks. I mean, the problem is how do you predict it? And I think anybody who believes that it's not the case is naive, right? The very fact is that it's very hard to predict. Now, to the natural resources side, when you see that demand rising, and you pretty much see it in all fields, the demand is rising very, very fast. It is driven by the build-out of cities, the build-out of economies, and the enormous wealth creation that we see in so many places that has not happened before, and therefore it creates scarcity. Scarcity at the same time also creates some phenomena. That's a driver of pricing, right? That creates some phenomena. Some of those are good, when it comes to a drive for efficiency, and some of those are bad. When you see some fallout, we see some aspects of illegal mining happening, and when you see some of the elements of drastic substitution happening, that can also be a positive thing. But I really believe that when you look at things like copper, for instance, where you frankly see a depletion of the resources worldwide, the quality of copper has gone down. The copper mines that have not been opened are in areas that are very, very difficult politically. So, I do think that we have to be very, very careful in looking at the natural resources.
What's the solution to it, Klaus? Because if they're going up and there is all this demand, how's that train going to stop?
Well, to quote the modern version of an old U.S. movie, when the son asks the dad, "Daddy, what do you think? Which industry should I go in?" I think the answer today is aluminum, so not plastic. So now I think what the positive thing is, it drives for intelligent substitution, more efficient use of materials, and that's the good thing. The other thing, it will also drive a different distribution of income and inflation. Right?
explain what you mean by that, different distribution of income?
Well, look, I mean, in the end, when there are very little choices in some cases. If you want to build out an industry like China these days, even with the maximum of material substitution, you do need steel. Right, steel needs iron ore. You know, iron ore has become a very expensive commodity. As much as aluminum replaces copper every day, pretty much, you know, you still need copper for some applications, at least for quite a while. Copper is depleting, so therefore demand will not go away. Therefore, prices will go up. Right? As you know, Farid, I'm a big believer in innovation, and I think the most fundamental thing that we always underestimate is the human genius and the creativity of inventing new things. I think this is the most encouraging theme throughout the history of mankind. So I believe the good news is there's a lot of stuff that we don't know about yet, which will happen in a positive way also.
Eckhard, the German economy is currently the kind of poster child, everybody's favorite economy. Everyone wants to be like the Germans. I want to ask you about the possible dangers that lie therein. How do you read it? And B, how do you deal with the problem of German banks? When people talk about Greek debt, Portuguese debt, Irish debt, of course, a large part of this debt is held by German banks. So are your banks as well run as Jamie Dimon's bank?
I mean, the latter part of your question is hard to assess because I'm not a banker, but let me try to respond. I mean, first of all, yes, it's true. The German economy shows remarkable strength, and it's, in my view, looking 10 years back, it's relatively easily explainable, in my view at least, because, and that's an important point. Germany has significantly benefited from the Eurozone. I mean, German industry has dramatically increased competitiveness over the last, say, 10 years or so. Very moderate wage increases in Germany. Had we not had the euro, obviously we would have seen a significant appreciation of the German Deutschmark, which has not happened. So we have increased competitiveness. The appreciation of the euro was sort of moderate, which obviously, and in the, you know, given the fact that the German industry was still innovative and had come up with innovation, that obviously to the fact that, you know, we have now a GDP growth which is pretty much driven by exports. Having said this, I think there is almost sort of a moral obligation of Germany, German politicians and German industrialists or economists to give support to countries like Portugal or Greece or what have you, right? So I think, you know, in a sort of a comprehensive picture, one has to bear in mind, you know, all these, you know, fruits we have been able to reap over the last years. Let me put it that way, and my view is, we and also the German banks, I don't say especially the German banks, but also the German banks, should pay back something in light of what has happened.
So, Maurice Lévy, this is a cogent case for the Germans to do something about this debt. The way I would put it, it seems to me, if you centralize Europe's debt, there really isn't a problem because Germany and to a certain extent France can afford to pay these debts. But these debts are not centralized, and as a result, this isn't happening. And of course, if you centralize the debt, the cost of servicing these debts would go down. So the economic solution is pretty obvious. The politics is the problem, right?
The European organization is not yet completed. So the way we are working in Europe is still with the member states, and each member state has its own policy. And in terms of economics, we have not today a centralized economy or a centralized organization which can coordinate the politics of Europe, unfortunately. And that's the reason why we are having the Portugal, Greece, or Ireland problem. But by the same token, what we can say is that if you look back at what would have happened to Europe if we had not the euro, if we had not the organization of the European Union, and the coordination which happened recently, I think that we would have been through a terrible crisis. Greece would have been going bankrupt. They would not have been able to pay their debt. Same for Ireland. And I think that the European system, by and large, has worked pretty well. It's not perfect, far from that, but it has proven to be resisting to this kind of crisis. I think that we can improve it if we could have at least a economic policy which is well coordinated at European level.
But let's stay with the European crisis for a second. Jamie Dimon, how does it strike you? Because what I'm struck by is Angela Merkel, who I think is going to be at Davos, has been protesting, has been demanding conditions, and what I notice is, of course, by doing all this, she's driving up the price of the eventual bailout, which she will have to pay for. In other words, the first rule of bailout seems to be do it fast and do it big, and then you might not even have to pay much. If the history of TARP is any lesson, it is that if you go in big and early, at the end of the day, it's a confidence game, and the money comes back. But if you get there being dragged and screaming, you will have to pay a very high price.
Right. So let me just give you a thought about it. First, I think the European Union is one of the greatest human endeavors of all time. That mankind can come together and try to create a union. After centuries of wars in Europe, and it's a wonderful thing. And I think when it started in 1950, I don't think people really thought it would get this far. And as it gets there, states are slowly giving up their sovereign rights. Though it is really hard. They don't have central banks. They have common regulations. Where I disagree, and I agree with you, a stronger, better approach would have been do something right away. But I don't agree that simply say, let's just socialize the debt. Because there's a fundamental underlying problem, and the underlying problem is if this nation is retiring people at 55 with 100% pensions, generous social programs, and this nation's and working 33 hours a week, and this nation's working 40 hours a week and 65 retirement, one isn't going to pay for the other. I mean, it will be a matter of time before people say we're not paying for their lifestyle. I'm not saying there's anything wrong with their lifestyle. That's their choice. But if you socialize the debt, that's kind of what you're doing. So I think what they're trying to do is get through the crisis now, but make sure they put the things in place that make it survivable. So I think you have seen a lot of the peripheral nations make some very tough choices. They're changing their pensions, they're changing their laws, they're changing the requirements. They have to become more competitive, so it'll balance out over time. So even after we get through this, that the Maastricht Treaty, how you run deficits, social policy, all is going to have to be reset to make sure it's fair to all the nations in Europe, and that some aren't just piggybacking off the success of others.
But Eckhart, do we have the time, or are we in such a there are bond auctions going to come up in the next 6 months? Can Europe patiently restructure the retirement, deal with some of these issues, or is there a crisis here that needs to be dealt with?
You mean a crisis, a
sovereign debt crisis?
Sovereign debt crisis. Yes, obviously there is. I mean, it is. I mean, I agree with what Jamie said, that you should not sort of socialize debt. That's one thing. But on the other hand side, I mean, if you look at the options we have in Europe, this is a purely European perspective now, right? Indebtedness, in general terms, is high. There are obviously some countries. I mean, we all know them. For which it will be extremely difficult to sort of serve their debt, or to sort of, at the end of the day, pay interest or what have you. So my view is that, I knew that this word of Euro bonds is not very popular, especially not in my home country. But there is two options. Either you sort of continue the way in debt financing on a country-by-country level we have seen over the last, in the past, which, in my view, inevitably will lead to the fact that some countries, at the very end of the day, will go belly up. This is option one. And then you have to be bold enough to sort of deal with the consequences. Or you sort of help these countries in terms of reducing their interest or debt load. And in my view, the only option to do this is to at least partially, not entirely, partially also, sort of introduce Eurobonds, which will in some way obviously be subsidies from countries like Germany or maybe France to countries like Ireland or Greece or Portugal. But you have to make up your mind and your choice. In my view, those are the only two options.
Maurice?
When you look at what's happening currently in Europe, you would be very much surprised to see how the European governments are resisting the crisis. We have never seen so many people in the streets in Greece, in Ireland, not so much in Portugal, but in these two countries. I think that many governments should have fallen or have went backwards and decided to change the policy. But they resisted, and they have implemented very tough measures. This is unseen in Europe. What happened, for example, in France regarding the change of the pension system, with every single week you had millions of people in the streets. I don't know any government who would not have stopped the negotiation and said, okay, I surrender and I will come back and in 2 years' time and we will create a commission, we will negotiate and we will have something in 2 or 3 years' time. This government has resisted. I think that there is a new kind of wind in Europe. People are very much conscious of the issues. They know that there are some very, very tough issues that have to be solved. This is, all the governments are paying a very high price. I don't know a period where the popularity of governments were so low, and they are accepting. They are not stopping the reforms, and this is really very, very new in Europe, and it's refreshing in a certain way, and I believe that this will bring a lot of changes.
Let's stay with Europe for one more second. Jamie Dimon, play out for me what happens if you don't have a bailout. And I'm just using the word bailout generically. You can use Eurobonds, you can do whatever you want. But if you try to get Greece to restructure its debt, on that day, what happens to all the money in Spanish banks, in Irish banks, in Portuguese banks? Will it not all move to Germany? Will you not have a serious crisis of the European banking system? So what I guess I'm asking you is there any way in today's modern interconnected financial system to restructure one country's debt and imagine that it could not have a kind of seismic systemic effect?
Right, so I think the European Union has picked the only good choice, which is to get through this crisis, because if you don't fix it here, you are going to fix it there. And the there is in the banking system. And a lot of these banks did buy just not their own sovereigns, but European sovereigns. And it's the same money, by the way. So you either help it over here or you help it over there. If you do it after the banks, you might be in a crisis. So that would, to me, that would be the lesser solution. And there are these unpredictable effects of money moving around the world, certain banks doing well, certain banks doing badly, certain countries having a complete run on deposits in their country. So I think it would be too risky. I think they are doing the right thing, and then face the real complicated issues when they have a little bit of time.
Dominic, Barton, you wrote in a terrific HBR article about a kind of new capitalism almost for this new age. Describe very briefly what you meant.
What I basically was arguing was a need for more long-term capitalism. I think we've talked a bit about it here. There's been too much short-termism in government, but also even in capitalism. So there's really three elements. One is that we shift away from the quarterly earnings obsession and focus, and some companies have done that. Unilever, Coke, Google's never done it. But more having investors that are thinking more long-term, because I think that provides more stability and the cycle time to actually build business. You can't build a business in 3 months. It can take 6 to 7 years. I think there's a second element, which is really around the stakeholder versus shareholder. I think businesses are going to have to realize that it's in our interest to think about the broader community in which we're working. And I don't mean just CSR. I'm talking about understanding what's actually happening to youth unemployment and so forth that affects business. What are you doing on that front? And there's a lot that's happening on that dimension. And it's what I'd call owner-based governance. I think I'm a big proponent of corporate governance, but are boards able to really understand what's going on and deal with the issues? And I think having, again, more long-term perspectives in the board, supporting the CEOs. I mean, the turnover of CEOs has been at an unbelievably high rate. I think that if we're very short-term in terms of how we run our businesses and how we do our capitalism, I think we will see more crises that will actually occur.
Klaus, is this you were CEO of Siemens? You're now CEO of Alcoa, an American company. Is this an argument for European capitalism versus American capitalism? Do you think one kind of capitalism is better than the other? What lessons do you draw from your two experiences?
Well, there are differences in the governance models between both places, and I would even argue that there is not only not one telephone number for Europe, as Henry Kissinger has once said, but there is also not one governance model for Europe. I mean, the German governance model is substantially different from the French and substantially different from the British one, for instance. Every single one has a history in the country and works in a certain environment, has pros and cons. I'm personally a strong believer that you want to run a company in the fastest possible way to be able, particularly in a fast-moving competitive environment, to position yourself quickly, and then it all boils down to making the right choices on the human side, right? If you don't believe that you've made the right choices, then I think it's very hard to correct it through having an overlay on top of an overlay on top of an overlay, because then the whole system gets totally confused and nobody knows now which direction do you want to go to, right? So the U.S. model is a very clear model where you even have the option of being CEO and chairman as one, where it's one clear voice into the organization. And I think when I look at, we've just gone through the most drastic crisis our industry has ever seen since existence of the industry, and gone through it and coming out of it even stronger. I think that would have been very difficult if it wouldn't have allowed us to have a clear message inside of the company, move very quickly. So it had advantages there.
One of the ways that you have come out of this crisis very well, and you're not alone in this, is that you have focused in on productivity. You have really achieved extraordinary improvements in productivity, but a lot of that has come from cutting labor. And there has been pressure on labor in almost every major American corporation, particularly it seems to me those that are involved in some way or the other in manufacture. Isn't there a danger that the fate of American corporations is increasingly decoupled from the fate of American employment? The S&P 500 is doing fantastically. The average American worker is not. What is the solution to this?
Well, if I look at the program we have done, we actually could not afford to leave any aspect untouched. So, I mean, we have in total saved more than 2.5 billion from procurement. So if you look at the impact, the financial impact of our program, the procurement side was without a doubt the biggest one, right? So it wasn't labor. And when you look at the cost structure in many of our businesses, actually labor is not the most defining one in most of the cases, energy or bauxite input, you know. So I think that is one thing that needs to come into the debate. I think simplistically said, because everybody wants jobs, I mean, people always make the assumption as though labor cost is the most critical one. I mean, in our industries, in most cases, that is not the fact, right?
But it's still true that you let thousands of workers go.
Yeah, because we could not afford to leave any one of the levers out, and labor productivity certainly is one of it, right? But I think the single focus on that alone is difficult in the argumentation, right? The focus on jobs is very important in my view, but I think the other mistake that we're making is to always look at the established players and basically say, you know, are the jobs coming back for General Motors or whatever, Chrysler or in Alcoa? And I don't think that when we look at history that is what historically has happened. Historically, we have seen new industries growing, and those ones being the one that also bring new jobs. And I mean, there are some industries even, because then the argument comes, okay, but for those jobs, you need better qualification. Partially true, partially not true. Partially not true because one of the things that is growing in the Western economies is the average age. With the average age, there's also a gigantic demand for services around aging. I think we have really limited our creativity to think of those type of jobs that don't require necessarily a gigantic educational background, right? But we have failed so far to establish those services because for elderly people, you don't outsource. I mean, the person stays in the country, right? So it's very difficult to outsource those services. You basically have to perform them around the person. We've always looked at healthcare as a cost factor, but I think we can also look at healthcare, for instance, not only as a driver of innovation, but also as a job engine.
Dominic, when you look at what is going on in the emerging markets, it feels to me like the wage pressure that the Western worker will feel has only just begun. There are auto parts manufacturers in China and India that supply Ford that pay their engineers $10,000 a year, and that's a good wage. They are supplying the same parts that used to be produced in Michigan and Stuttgart and places like that. What's going to happen? Isn't this going to be a great crisis for the Western world? I mean, of the potential of real wage deflation for Western workers.
I think there's no question that there's a huge amount of pressure on wages on that front because there's still a lot of people in this urbanization that are moving into the cities and looking for jobs. If you look at just the job creation demands of the Chinese government, 23, 30 million a year, it's huge. That said, there is wage inflation that's going on in China right now. I think it's about 17% last year. They're focused on productivity, but I think there's a long way. There's a long, big reservoir, if you will, of people that want to work. Vietnam is coming on stream in a big way. Indonesia is beginning to come on stream. So I think it will over the next, at least the medium term, 5 to 10 years. I think there will be significant pressure.
Eckhard, how the Germans deal with this by moving up by moving up the value chain, producing more complex goods, selling them for more money, the sort of BMW model. Is that something? Can a whole society, tens of millions of people, move up the value chain like that?
The question is not whether they can. My view is they must. We've got no choice in countries like Germany, and that's why it's so important. I mean, Klaus was just touching upon the demographic development. I mean, the challenges we're going to be facing there are not sufficiently on the radar screen yet. That's number one. And number two, what do we have to do in order to sort of at least keep the wealth level, if I might put it that way, which we have today, is to invest into education, train people, educate them, and which then ultimately brings the sheer necessity to move up the value chain. Because what we're just saying, I spent a lot of time in Eastern Europe and in Asia, unless we in the mature Western European countries get a message across that the world is different from Western Europe. All these young people, who have graduated and burn and want to achieve something, unless we get that message across that we have to sort of really, let me put it that way, attack again and be conscious of what's going on outside Europe, especially Western Europe, will lose comparatively at least to other regions of the world. To cut a long story short, it's not a question whether we can, we must.
Maurice, one of the things that the World Economic Forum's Global Risk Survey talks about, it identifies as one of the key global risks going forward, is the increasing inequality of income and the increasing inequality of wealth. And the argument is, I think, that it's not just something that has a kind of moral, political problem, but that it's an economic problem, that with this level of inequality, you do not get the kind of general consumption that an economy needs. Instead, you get asset bubbles because the rich will tend to invest in assets more than consume goods and services. But when you look at the causes of this inequality, I'm wondering whether you think much can be done about it.
I think that there is much more than that, if I may. And following on what has been said by Dominic and Klaus, I think that the first thing that we have to think about is that the one who paid the price for the crisis are the workers. And there has been millions of people who have been thrown away from their job, sometimes from their houses, that they have lost everything because of the crisis. These people have lost faith in our economy, in our system, and we have a moral issue which is very important. And in today's world, there is a huge suspicion about CEOs, bankers, corporations. And we have in the Western world first to deal with this, because you mentioned the 500 S&P companies who are doing extremely well and the other are not. We have the same issues with the FTSE 100. We have the same thing with the CAC 40. People do not understand that these large corporations are doing extremely well while their lives have not improved. And without the support of our citizens, without the support of the people, there is no way that we will be able to grow. So we have 3 or 4 issues that we have to deal with. The first one is an ethical issue. People believe that we have not worked ethically in the last years, and if there has been a crisis, and if the crisis went so far with so much damages, it is because we, the CEOs, have not dealt ethically with the way we are conducting the business. The second issue is much beyond CSR, which is the fact that we have not had a behavior which is humanistic. We were just led to quote them, and this is coming from all the surveys, and not only in Europe, it is also in the US, it is also in the emerging market, not regarding their country, but regarding the Western world. The big issue is that they felt that we have been led by greed, we have been led by only the bottom line, the profit, and we have sacrificed the workers in order to please the stockholders. And this is something which, if we don't change it, will really have a huge impact on the way we will be conducting the business in the future.
Let me ask about one specific element of this, which is, of course, bankers, Jamie Dimon. There is still, as you know, if you look at polls in the United States, still a widespread feeling in the United States that the taxpayers bailed out the banks, and the banks are not helping the taxpayers. They're paying themselves big bonuses, but that lending has actually contracted in aggregate. You may be up over last year, but overall, if you look at the amount of lending, which is about $7 trillion, you're still at about 2005 levels. What do you say to the average American taxpayer who says, guys, we bailed you out, now give us, do something in return?
Okay, I'm going to answer that question. I just want to go back. I want to give you an example for everyone here a little bit about this, what decisions you have to make, and about the short term versus long term. First of all, we don't run the company for quarterly profits. Matter of fact, anyone who runs a company knows that profits in a quarter are really based upon decisions made over 10 years. In fact, to some companies, maybe 20 years, 30 years. And, it's affected by a million different things, from demand to supply to commodities, and so you make long-term decisions. You mentioned the S&P being up, directly related to employment. And, the S&P profits are the same thing. They're not really directly related to just employment. They're related to all these various things. Ask yourself the question, would we be better off if companies were losing more money and laying off more people? So we're better off if the companies are doing well, not doing badly. And I think most companies try to take care of their workers desperately, in every way, shape, or form. And so we had a decision to make in Europe. We have huge exposures in Europe. Okay, so make believe you're my, and this is the conversation I have with my board of directors. Okay, you talk about helping people and not helping people. We could have dramatically pulled back that exposure. I mean, very quickly. just pulled funds out of every country, all we want, hedge it, move out, protect ourselves. That's not what our board said. Our board said, let's be rational and careful, but we're in Europe for a long time. We serve a lot of European companies, and we left big exposures there. And now, does that mean if we lose money in a country, and we could lose $1 billion or $2 billion, just like that we were stupid? No. And I don't care, because we're here to serve clients. Our clients need us, and we stayed in those countries. And so it isn't like we make these decisions just for pure profit and run away, and because that was what maybe some people do, and certain investors, it's exactly what they do. It's not what JPMorgan did. I don't think it's what a lot of the banks did. And about banks, in the United States of America, only 1/3 of credit is provided by banks. Bank lending actually went up after Lehman Brothers failed, not down. Huge misconception. 2/3 of credit is provided by individuals, corporations, pension plans, et cetera. The huge reduction in credit supplied was the credit supplied directly to the marketplace. In fact, if you go to any place around the world and ask people, did you do something more conservative with your money after Lehman went down, almost everyone says yes. I always say, well, you caused the crisis. You got scared. You ran. Perfectly legitimate as an individual, protecting yourself. And JPMorgan last year lent or financed $1.4 trillion for corporations and individuals around the world, up pretty substantially from the year before, and I believe substantially from the year before that. Most banks are lending quite a bit. Now remember, some of them are gone. The ones who are gone are no longer lending. So obviously there's been a reduction. So you might talk to people saying, I can't get money, and maybe standards have loosened up in the last year, but they have not tightened up. So banks we are lending aggressively to corporates, to middle market, small business lending up 30%. There is, if you talk to most economists, there is a demand issue. A lot of people don't need the money, so because they're not building inventory, they're not building plans, they're not building. A lot of these people have tons of cash. They don't need to call up their banks because they got plenty of money right now. So
let me ask you about one more consequence of the crisis, if I may, which is.
And there's a huge misconception, which not all banks needed that TARP. And not all banks would have failed. And when I hear a lot of policymakers and regulators, that one assumption drives so much the anger that they all would have failed. I can tell you a lot of banks were stabilizers in this problem. JPMorgan bought Bear Stearns because the United States government asked us to. We bought WAMU because we wanted to. Wells Fargo bought Wachovia. HSBC was strong through and I go bank after bank who was a stabilizing force, trying to make up for the fact that there were other failures. And so we lumped everyone together, and I think this is a terrible thing to do. I don't lump all media together. There's good and there's bad. There's irresponsible and ignorant, and there's really smart media. Well, not all bankers are the same. And I just think this constant refrain, bankers, it just doesn't, it's really an unproductive and unfair way of treating people. And I just think people should stop doing that. I think it denigrates everything. Not all companies are the same, not all CEOs are the same, not all media is the same. And so we try to do the best we can every day.
Let me ask you about another consequence of this crisis. It has been to concentrate assets among the top banks. JPMorgan, Citigroup, Bank of America now represent 30% of all assets. You have about $2 trillion in deposit. It strikes me that the net effect of what has happened is you're not too big to fail. You're way too big to fail.
Yeah, so it's 30% of all deposits in America. America is far less concentrated than Europe, Asia, Canada, Australia, France, UK, Italy. I mean, way less concentrated. There are reasons for economies of scale and stuff like that. I believe that when we start talking about resolution authority, that the governments, the regulators should be able to take down a JPMorgan in a way that doesn't damage citizens of the world. And I also think the banks should pay for that. Like in the FDIC, when banks fail, the FDIC takes them over, kind of liquidates them, and the rest of the banks pay for it. We're going to pay $5 billion to the FDIC for the failure of other banks. Instead of calling it resolution, I think we should have called it minimally damaging bankruptcy for big, dumb banks. Take them down, wipe them out, full bankruptcy, unsecured creditors pay. And that's what they're trying to get to. It's a little complex. It can be done. That's what the FDIC did with big banks for many years. Now we've become global. So I understand if you're a regulator, you need to say, okay, what can I do in the UK? What can I do in France? Can I protect myself? And the answer is you can. It's a little complicated. It can be done. And that's the better way to do it. Let these companies fail. Put them in a position where they can all fail and the world is fine.
Could JPMorgan fail without systemic risk in the United States today?
If it's set up properly, the answer is yes. So, and the other thing I remember, if Lehman Brothers had failed in 2000, the other thing about complex systems, if Lehman Brothers had failed in 2005, I don't think it would have caused this crisis. I think it was cumulative trauma after, you had problems in Germany, you had problems in Britain, you had problems in the United States. And the United States was the epicenter, I'm not going to deny that. But it was AIG, WAMU, mortgage brokers, and it was around the world. And so things would be very different if they were set up so that they could be handled. Lehman Brothers had $200 billion of unsecured debt. If at the point of failure, that unsecured debt had been turned into equity, Lehman would have had $200 billion of equity and $600 billion of assets, and it would have been fine.
Has the financial reform, Larry Summers on my program last week said, financial industry fought this reform tooth and nail. They spent $1 million on each congressman, 4 lobbyists for every congressman. Is this financial reform going to change things?
I love Larry, a ridiculous statement, okay? First of all, it's I remind these people all the time that in a democracy, you have the right to petition your government. It's in the number 1 amendment in the U.S. Bill of Rights. Most of that lobbyists by our own people. When I go to Washington, it counts as lobbying time, and we have to add it up, and how would they calculate and stuff like that. We didn't fight financial reform, okay? We wanted resolution authority. We thought there should be oversight committees. We thought derivatives should go to clearinghouses. We thought there should be better consumer protection. We fought the parts of the reform we thought were irrational. That's all. It's not like you were for or against reform. I completely acknowledge the need for massive reform after what happened. Totally, absolutely. But, some of the stuff that got done was just not rational. So, for us to say we're supposed to just bend down and accept it because we're a bank, that's not fair. So, and Larry knows the detail, too. He knows that some of these things, matter of fact, he didn't support all the reform. If he was to stand up here, he'd agree with me that, there were a lot of things that had nothing to do with him. It was just, people in Congress coming up with their own ideas and would make sense.
All right. Jamie Dimon's proposed resolution authority, for those of you who didn't catch it, is the MDBBDB. Minimally damaging bankruptcy for big, dumb banks. Somehow I feel, Jamie, you're a great banker, but you haven't come up with a good acronym for legislation.
We will work on it.
We've got a little time for questions from the audience. Sir, in front. And please direct your question to one person, because we can't have 5 people weighing in on every single topic.
I'm Joe Schoendorf from Accel Partners. We're venture capitalists. You've talked about shocks, and you've kept a lot of it on the financial side. We've got half the world that are under 25, and this is the most connected part of the world. There are 4.5 billion mobile phones, and there's 500 million people on Facebook. And full disclosure, we're lead investors there, and they're unemployed at probably twice the global rate. We saw what happened in Tunisia when you had a connected group of people and what could happen in a very short period of time. I'm not sure I care who answers it. One of you pick it. But with a connected society where you've got an instantaneous ability to get people together, and you've got this overhang of people under 25 who, 1, don't have a job, and 2, don't have a prospect for a job, what are we going to do about that?
Eckhart, do you want to take this, as the country that doesn't have any youth unemployment? Maybe you look around Europe, Spain has 40% youth unemployment. This can't go on.
No, it cannot. But, extremely, complex question, but you have to differentiate. If you look at Europe again, and let me start with the European picture, obviously it's completely different. In the percentage of young or younger people is going down, and we talked about it, and the percentage of older elderly people is fast, going up at a very fast speed. So the European problem is a completely different one. We don't deal with bringing employment to young people, but how to survive given the social security systems in light of this demographic development. The other thing is, you are right, yes, there is, but take a look at China. So far, don't get me wrong about China. For me, is sort of the model case. How they deal with those challenges. Not just bringing people from the west to the east coast, but investing in infrastructure and bringing jobs from the east. Talking China still, from the east to the west. So my view is, maybe I'm overly optimistic, but my view is that in those countries which really have to sort of handle or manage that problem or challenge, they are conscious about it, they are aware of it, and in my view, they do the right things. And what also helps is what we just said, that, Europe, or my country, Germany, we sort of, if you will, bring jobs to developing countries, and we were touching upon that earlier today, trying to, sort of move ourselves up the value chain. So I admit it is a great challenge, but again, I'm not too pessimistic that people would not be aware of it and conscious about it.
Other questions? Sir, at the back.
Arjun Dhawan, HCC India. To either Mr. Barton or Mr. Kleinfeld. If coming back to the question, if I may, on the fate of U.S. unemployment being tied to the American policies, how much do you worry about protectionism, considering that maximum amount of the wealth creation in the last number of years has been among the top 1% of households, along with the fact that the degree of job recoveries, post-recessions have been basically starting to get even more normal over the last 20 years or so.
Dominic, you want to take?
Yeah, I mean, it's a big conundrum on how to get the job growth as we move forward. I actually think there are lots of opportunities in the U.S., and I think there's a push on that right now. One specific area I would talk about, which is kind of a reverse east-west area, is infrastructure. The state of infrastructure in the U.S. is in need of significant improvement, as we know. What many people argue, there's not the money to be able to spend to do it. There actually is money. That money's in China. And that, if you talk to people at the China Investment Corporation, they would be very interested in investing in U.S. infrastructure, hard assets, as opposed to bonds. And I think we have to be a little more creative and open about how we can look at where the sources of capital come in and then the infrastructure build. And I think that's just one specific example. I also wouldn't discount the innovation that's going on in a number of areas. You look at healthcare. Healthcare is a problem. It's also an area where people are going to be consuming it more because they're older. So it's actually it can create jobs. And I'm not talking about just the regular ones today. I'm talking about ones which are more related to technology as it relates to healthcare. So I think there are a number of areas in that front. I don't think we have to assume it's just going to be a shift in the jobs that are declining in the West and going to the East. It clearly is a push that way. It can also shift the other way too.
Fareed, can I add into that? Because that's a very good question. There's a group of leading economists, by the way, that have gotten together at the beginning of the crisis worldwide and that have developed a tracking system of protectionist measures. And that's actually also ties into Joe's question, because the difference in media makes a difference. And what they are doing is, and they've done that from the start on, whenever there is a protectionist measure in a country, they actually publish this widely. And it goes around the network and it's getting tracked. And the amazing thing is, in this gigantic crisis, almost no strong protective measures have been taken by governments, which I think is stunning, because when we went into it, I mean, I would have been exactly where your question was heading. I would have predicted a massive flooding of barriers of entry, and it didn't happen. And I think that the very fact that people got together and used modern media worked very well in this case.
Any other? I think we have time for a final question, sir, over there.
David Nadler from Marsh & McLennan Companies, U.S. One potential shock near term based in the U.S. is the whole crisis around state and local governments and the issue of their debt, the pensions, healthcare crisis, et cetera, and the potential threat that might pose. We don't yet have people striking and marching, millions marching in the street, but it's an issue that faces. I'd be interested whether it be Jamie, Klaus, Dominic, on your views on how to what extent do you see that as a significant threat near term, as all those governments, we have a sort of a mini Europe at play across our country?
Jamie Dimon, why don't you take that? What is the danger of a municipal default by a state, California, New Jersey, or a locality? And if I can add to that, with this one for the complexity, you have a large number of people who've come into Congress from the Tea Party who say the one thing they're sure of, there are no more bailouts. So is there, what people would call tail risk? Is there some risk here that you have pressure on some U.S. state or city, and the federal government actually doesn't come through because of this anti-bailout atmosphere in Congress?
Okay, so completely separate the states from municipalities. States have a lot of wherewithal. When you talk about these huge deficits, the deficit in California is equal to 1% of the GDP in California. So if they raise taxes 1%, they could pay that deficit. And that's true for some of the other states, and they have the wherewithal. There are 14,000 municipalities, and you are unfortunate to see some bankruptcies. And the 14,000 go from very small to obviously some very large. And it will be an issue for some, and they have built up these obligations, pensions, kind of snuck up on people because a lot of these, like governments, when like corporations used to until they changed accounting, you can give things away today, they don't cost until later, and you don't have to put it in the books today. So I think you're going to see some municipalities use bankruptcy courts to try to renegotiate some of those contracts. But $3 trillion of total state and municipal debt is, with all the, and a fraction will have problems. And I don't think it's going to cause a systemic issue in the United States. It'll be headlines, you'll see kind of some to and froing. And the total deficit of all states and all municipalities is $200 billion relative to the total U.S. deficit of $1.5 trillion. So that is really kind of small relative to that. It's there, it's a concern, it's going to have to be fixed. I just don't think it's going to stop growth in 2011 or 2012. It's just a negative factor overlying the American system.
Okay, can we close by getting one thought? And what is the thing that worries you the most? And if you can keep it to one sentence, just, what is the shock to the system that you're most worried about? If I can start with you, Eckhart.
Well, it's not a shock to the system. What worries me most in mid-long term, again, European perspective is, and I mentioned it several times this morning, is the demographic development in Europe.
Maurice?
What worries most is what I cannot see, what I cannot expect. And if you look at all the shocks that we had to face in the last few years, they came from places we were not expecting them to come. So it's the unknown. The other thing,
the unknown unknowns, as Don Rumsfeld would say.
The other thing, which is not a worry, it's a hope and a worry. It's what's going on in the underground world of internet and all these blogs, tweets, and communication, and which can lead to a different kind of society with some good aspects and some aspects which we don't understand today, and I'm not sure that we will be able to understand it even tomorrow.
Jamie, what keeps you up at night?
So I'm going to use the word bad policy, but before I use that word, I want to say that I think the governments of the world did a tremendous amount of things that saved it from getting far worse. But if you read a lot of economic history, and particularly this book, and I know Ken Rogoff is here, Reinhard Rogoff wrote a book about This Time is Different, about 8 major crises, that financial crises take a long time getting out of. But it's not a given that it has to take place. Very often they take a long time getting out of is because policies in the middle of the crisis, sometimes for venal purposes, but often just a lack of knowledge and lack of understanding, actually make it worse. And I would love to get people back to work, employed and growing. I think it's the most important thing that we have to do. And I know they're unknown, and I agree with you, but to my attitude, geopolitics, unknown, they're always there. And they're always going to hit us somewhere where we least suspect it. So we've got to be prepared for those.
Klaus?
What worries me most is the increased or continued volatility in the financial system, and I would include in that the currency side, and that is accelerated, in my view, through technology and very hard to calculate, because on the physical demand side, I'm a total bull, I'm totally optimistic.
Dominic?
I'd say two things. I think, first of all, like Jamie, I think there's a lot of torpedoes in the water, but there always will be. The ones that worry me are more on asset price bubbles, commodities. But what I worry most about is actually the foundations, which is the trust level. People have talked about it. I mean, the government, I think, has drained the trust bank to be able to do what they had to do, and I don't think there's much reserve there. I think businesses have also, we've drained a bit of the trust bank, and we have to rebuild it to be able to withstand crises that will inevitably come again.
On that note, thank you, gentlemen. Terrific panel. Thank you all.